Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Monday, the 12th of December. I'm Daniel Lam, your host for the podcast. This week will be an action-packed week in terms of macro events. We have the US CPI on Tuesday, and then FOMC decision by Thursday, Asian early hours, followed by the China Central Economic Work Conference. Today, let us focus on how US assets have been shaping up going into these events and how you should be positioned. In December, there has been interesting divergence between bonds and equities. Now, usually, equities would enjoy relief rally, particularly the high beta stocks, when there were falls in yields. But as US 10-year Treasury yield went from 3.6% to 3.4%, S&P 500 performed poorly. Some mild rebound equities followed before both bonds and equities were sold off again over the last few sessions. Interesting development, so let's dig deeper. If you look at the price action in S&P 500 index, you will notice that most of the selling occurred in the market open on Monday and Tuesday last week. Now that is typical of retail selling behavior. In fact, over the last few weeks, there has been declining buying activities from the retail investors. This can be linked up to the slowing down of consumption in general in the US, where the wealth effect has been diminishing due to factors such as inflation and also falling asset prices. In fact, the equity positioning of retail, systematic, and hedge funds are all sitting at or near their lows for this year. Could this change going into year end? Well, that would be highly dependent upon the outcome of US CPI and FOMC. But as we all know, out of the 10 releases for this year so far, 9 of them have been tail events for US CPI, referencing the shape of sell-side forecast distributions. So, how should you be positioned going into these week's macro events? Well, if you look back into the speech by Powell back at the Brookings Institute, it was not as hawkish as what investors have expected. But still, equities did not have a sustained rally in the US. The narrative of recession and concerns about the impact of hikes have on the economy is likely to be the key to focus upon in the first half of next year. Thus, if there were to be any short-term rebound in S&P 500, particularly if it gets to the 4,100 points post-CPI or FOMC, investors should consider rotating into higher quality income assets. They should also look to extend duration in their portfolio, as longer-dated yield levels may be capped due to the potential looming recession. That's all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.